Hi guys, whoever's tuning in, thank you ever so much. I know this video does not look aesthetically pleasing, but it's absolutely fine. I am GK and it's 35 days to SBR exam. Now, today what I'm learning is about revenue, which is IFRS 15 right here, which is really important part of SBR International. This is basically about when and how companies recognize revenue from contracts with customers. Now, I have broken it down in simple and logical way, so hopefully if I explain it to you guys, it may make it easy for your exam or for your fellow students, whoever's studying SBR basically. Now, IFRS 15 basically tells us exactly when a company can say, yep, we've earned this money, and how much of it should record as revenue. So we just can't turn up and just record revenue because you've made a sale. IFRS 15 has got this 5 clear steps that every company must follow before recognizing it. So it is important, and I've made a list of those 5-step model when to recognize revenue. Now, we need to think of these 5 steps as a checklist. You can't move to the next one until the previous one is done, basically. So the first one is identify the contract with the customer. So first thing, there has to be a proper valid contract. What that means is both parties have agreed, it has commercial substance, and everyone knows what their rights are, and payments terms are clear. And really important, it must be probable that you'll actually get paid. If collectability, sorry, if collectability is not probable, you can't recognize revenue yet. So I hope the first step has made sense. Now, step number 2 is identify the performance obligation. Now look at what the company has promised to deliver. Each distinct good or service is a contract in performance obligation, or performance obligation for short, PO we can say for short. So for example, if you sell a mobile phone and a network plan, there are 2 separate obligations, one for the phone and one for the service. So we need to identify the POs. Then, step number 3 is to determine the transaction price. Here we figure out how much money the company expects to receive. It's not just a sticker price, so we include things like bonuses, discounts, penalties. But what I've understood is that there's a catch. You only include variable amounts if it's highly probable that they won't reverse later. So step number 3 is determining the transaction price. Now step number 4 is allocating the price to each performance obligation. So if the contract has more than one PO, we split the total price between them. The split is based on like standalone selling prices, basically what each item would sell for separately. So that's our step number 4. And thereafter, we've got our step number 5, which is recognizing revenue when or as obligations are satisfied. Now, this is our final step. Revenue is recognized when control of a good or service passes to the customer. Now, that can happen either over time, for example, construction or service contracts, or it can happen at a point in time. For example, like when you sell a product in store. Now, all of these 5 steps, basically they are a checklist. So we can't just record revenue because we've just made a sale. IFRS 15 tells us exactly what to do and how we follow these 5 steps. Now, the only thing is, for C1A, that's the part that I was explaining, we need to master IFRS 15 for SBR, very important. However, this is just a very minute part of the SBR, which is just C1A that I've discussed. If you like this video, give me a subscribe and a follow, and I'll be making loads more because I'm studying and I'm trying to help other students at the same time. Thank you ever so much, guys.